Good morning, everyone. Welcome to the interaction with management of Cholamandalam Investment and Finance Company Limited. We will discuss 3Q FY26 earnings today. The senior management is represented by Mr. Vellayan Subbiah, Chairman and Executive Director, Mr. Ravindra Kundu, Managing Director and CEO, and Mr. Arul Selvan, Chief Financial Officer. I would now like to hand over the call to Vellayan for his opening comments, after which we will take the Q&As. Over to you, Vellayan.
Thank you, Nishant. And good morning, everyone. I'm happy to take you through our performance for Q3 FY26. We had aggregate disbursements of 29,962 crores, which is a growth of 16% year on year. And that takes our AUM to 2,27,770 crores. AUM growth remains steady at 20% at the end of this quarter. Disbursements saw healthy growth across all major product segments in the quarter. Vehicle finance delivered a 17% year-on-year increase in disbursements, supported by broad-based industry momentum across CVs, PVs, and two-wheelers in both new and used categories. GST rate reduction also helped bring down vehicle prices, which further strengthened customer sentiment and supported sustained demand across segments. LAP, home loan against property, home loan, and SPPL also delivered strong disbursable growth during the quarter. This momentum was supported by sustained housing demand across key markets, coupled with healthy traction in mortgage-backed lending for both self-occupied residential properties and SME credit demand. Q3 witnessed robust customer inquiries and improved conversion rates across segments, contributing meaningfully to the overall expansion of our retail mortgage portfolio. LAP grew disbursals by 26% year on year, and home loans grew disbursals by 10% year on year, and SPPL by 30% year on year in Q3 of FY26. AUM growth in these business verticals continued to be strong, with LAP clocking 31%, HL registering 27%, and SPPL having a 52% growth over Q3 FY25. Disbursement growth in the unsecured segment was also strong, with momentum picking up in Q3, registering a 32% growth over Q2 of FY26. Due to the withdrawal from fintech-based lending, the growth year on year continues to be negative over Q3 of FY25. This will change from Q1 of FY27, as we had stopped lending through fintech relationships from Q1 of FY26. Likewise, in SME, also the growth in disbursement over Q3 of FY25 continues to be negative due to the conscious slowdown in supply chain finance. On a sequential basis, disbursals grew by 16%, driven by term loans and equipment finance. The AUM growth was robust at 33%. The newly introduced gold loan business disbursed 772 crores during Q3 FY26, operating out of 118 dedicated branches in the south and eastern parts of India. As highlighted in our previous call, NIM was improved by 33 bips in Q3 over previous year, with the RBI's rate cut progressively impacting our cost of funds favorably. Operating expenses have remained steady on a year-on-year basis, even after incorporating the impact of the new labor code in this quarter. This reflects our continuous focus on cost discipline and productivity. Credit costs improve marginally as the impact of running down the fintech business continues to influence our credit costs. On the vehicle finance side, the credit costs have stabilized, and we are looking at a reasonable moderation in Q4. ROA for Q3 FY26 stands at 3.2% and ROE at 19.11%. With the second half progressing well, we anticipate Q4 to reflect improved performance in line with past trends. In terms of liquidity and capital adequacy, we hold a strong liquidity position with total liquid assets of 18,857 crores, including undrawn sanction lines. The ALM is comfortable with no negative cumulative mismatches across all time buckets. Our capital adequacy position stood at 19.16% in December 25, with Tier 1 capital at 14.12%. Out of the total issuance of 2,000 crores, CCDs amounting to 307 crores were converted in the month of October 2025. Further, 1,063 crores of CCDs were converted in January 2026. This will improve Tier 1 capital in Q4 of 2026. There is a balance of 633 crores of CCDs, which is expected to be converted in April and July of 2026. And finally, the board approved the payment of an interim dividend of 65%, which is rupees 1 rupee and 30 paise per share. So, Nishant, I'll stop with that, and we'll be happy to turn it over to you for questions.
Sure. Yeah, sure. The first question comes from Suraj Das of Sundaram Mutual Fund. Suraj, your line is unmuted. You can ask your question.
Yeah, hi. Am I audible?
Yes,
Yeah.
please.
Yeah. Hi, sir. Thanks for the opportunity. Sir, one question on the vehicle side. First, in terms of the asset quality, I mean, if I look at the, let us say, overall credit cost on the vehicle, that is running a bit higher versus your historical levels. Anything that you want to call out in terms of specific geography or particular OEM or probably any subsegment that is probably giving the cause, I mean, pain? While you are highlighting that probably the vehicle credit cost will see substantial moderation going ahead, but what could be the rationale? Is it because of, let us say, the growth and hence automatically the credit cost coming down, or it would be more from underlying cash flow improvement from the borrowers, or maybe the state governments payment coming in or something like that? So just first, if you can highlight, I mean, what is the cause of the this pain, because your vehicle credit cost is running at 2%, which is relatively higher versus the peers as well as your historical levels. That would be my first question.
Yeah. Morning, Suraj. So few data point which I would like to tell you about the vehicle finance is that stage 3 from June quarter of 3.89 has gone up to 4.11 in September, and December it is remained at 4.17. So in stage 3 we have got the stability now. As far as the stage 2 is concerned, it has 3.9 in June and gone up to 3.96, but it has come down to 3.6. So 30 basis point improvement in stage 2 has been seen, and also internally we are monitoring the early default and non-starters. Those are coming down significantly well in stage 3. It's in the quarter 3 itself, and likely to further improve in the March quarter. So this is in line with our plan only. Our NCL numbers in quarter 1 was 2.2, which has come down to 2.1 in quarter. The next quarter, and then in this quarter it has come up to 2%. So from the first quarter to third quarter, the NCL has also come down, though it is at an elevated level. But as you know that the first two quarter of the in India is actually getting impacted due to the rains and also capacity utilization get impacted. That is the case, the seasonal effect, and it is similar to the last year. But this year onwards, we are seeing that there is a good demand coming up. Vehicle demand has improved after the GST rate cut and all those things happen. And then we are seeing that disbursements are going up. That means the deployment of the customers have improved and the capacity utilizations are improving. So we are expecting quarter 4 of vehicle finance going to be very good, and then they are going to maintain it the next financial year. So coming back to your point that it is at elevated level, yes, but it started coming down in the stage 2, and early default and non-starter has come down. Stage 3 is stable. From here, it will go down.
Sure, sir. But sir, this early starter, or let us say the early delinquency coming down, is it a factor of underlying cash flow improvement, or is it a factor of more, let us say, growth? Because this quarter, the disbursement growth has been relatively good on a QOQ basis.
Early default is basically pertaining to the first 6 month or 12 month of the book where the customer is getting into the first delinquent. So it is nowhere related to the denominator effect. If one customer goes into the first bucket, it is early default or non-starter. Only the period we basically monitor, non-starter for 6 months, and so it is a very stringent norm, and it is nowhere getting impacted because of the denominator, and therefore early default and non-starter going down is it, and also stage 2 has come down for the full book. It is actually the indication that the collection efficiency is increasing. And in the month of January also we have seen that, which recently we have completed. So this trajectory is going to be maintained in vehicle finance. And not only in vehicle finance, we are seeing the similar impact in benefit coming in CSEL also.
Sure. And this improvement has been across OEM, across geography.
Across OEM, across geography, across the type of product new and used.
Sure, sir. And so last question on growth. I think this quarter the vehicle disbursement growth has been very strong. Partly could be pent-up demand also, but how do you see the overall disbursement growth going ahead?
Since we have seen the January, I have opportunity to tell you that things are looking better than quarter three in this quarter till now, because 30, 60 more days to go. So quarter four will be better than quarter three in terms of overall disbursement, and as well across all the businesses we are seeing the disbursements are up. Like quarter three, you would have seen that SME or CSEL are slightly behind in terms of the disbursement comparing the quarter three of the last year, because they were doing much higher and they have given up some portfolio. But now the disbursements are up.
Sure, sir. And if I can squeeze in last one question, sir, can you give the slippages and write-off number in vehicle this quarter or 9 months maybe?
Those numbers are consistent actually. We have not seen any significant change in terms of it has been 404. The write-up in
Okay, sure, sir. Thanks.
353. Yeah.
353.
353 up to 401.
Okay, and 353 is write-off.
No, 401.
Okay, and 353 is the slippages.
No, 353 was the previous quarter. I'm
Okay,
just
sure,
comparing.
sure.
It is 40 crore, 50 crore up.
Okay, sure. Understood, sir. Thank you so much.
Kunal Shah from Citi. Kunal, you go next.
Yeah, Mr. Kumar.
Yeah, hi. So the first question was on home loan credit cost, not a significant number in absolute term on the base where it is. But if we look at it in terms of the credit cost in home loans, that has gone up. So anything to read into it? Was there any one-off out there which has led to slightly higher credit cost? And the second question was on CSEL. So now we have started to see the improvement on the disbursement side. So there was a decent traction on a quarter-on-quarter basis on the disbursements. So going forward, maybe last time also you indicated that the stress has picked out in CSEL. So should we see now significant improvement in CSEL, and where should the credit cost stabilize compared to 6.4%? Yeah.
Yeah, just to start with the home loan, and this is one of quarter for the home loan in terms of their NCL. What they did is that the non-surface pool we were working on, and they got into the stage where the collection is visible through the legal. Now they have contacted or tied up with the ARC and given up 65 crore of their stage 3, wherein they booked the NCL upfront. So the NCL hit is in the line of HL P&L is around 35 crore for the 65 crore book, which is basically they removed. And the income line is actually slightly elevated because of the whole deal has gone up by 23 crores. So the P&L line is actually not much gap. Therefore, you can see that the ROAs remain at
Yeah,
the
yeah.
4.2%. So that's because of the, we take NCL line, NCL, not like in some of the players, we have seen that they do it slightly differently. NCL, they basically take it income also into the NCL line and keep the NCL better. But we have not done that. And we have also created a little bit extra provision because now we are going to get this money collected through the ARC. So we have not taken entire benefit, 5-6 crore extra NCL we have taken. So net, what I'm saying is that this, and even in the past we said that because the NBFC like Chola doesn't have the non-surface for less than 20 lakh rupee for SBPL and CSEL and SBPL and HF, and for lab also they have a small lab. Time to time, when we get into this situation where we are quite confident that in such thing we can collect money, then we will route it through ARC and get it done. And that is what is going to be the process even in the future. Once in a while it will be done. But at ROA level, if you see that they are at very high level, 4.2%, and they will continue to do that. And their target of ROA of 4.5%, pre-tax ROA, Prashad has been always saying that he will deliver it. So we should actually rely on his commitment. Now coming to the CSEL,
Sorry,
CSEL,
so
if you
one
see that,
thing, sorry on this. So there was a sale to ARC during the quarter, and we had taken the provisioning knock of 35 odd crores on that transaction. Is that the right interpretation?
yeah, NCL line. Yeah,
No.
I think accounting line let you understand from our CFO.
No, let me explain. So there is a 65 crores of assets sold, and when you sell, you have to write it off in the book, and the income that comes is coming in the income line. This is as per the Ind AS. So it's not like the whole thing has been removed from the book as assets, and you have brought the income, whatever the provision which had been carried would have got reversed. Net impact is around 35 crores in the NCL line.
Got it. Got
Which
it.
is 65 bips of the 1.1%.
Correct.
So if it wasn't for this, it would have been 0.45.
4%.
Yeah, and our
Okay.
overall NCL also would have been better for the company. But this is the right thing for the organization. That is what we have done it. Now coming to the CSEL NCL actually moving right direction. In quarter one, it was 6.7. Now quarter two was 7%, and now it has come down to 6.4. And in absolute value also, the NCLs are coming down because of the rundown of the partnership book. And also, we are seeing the overall NCL of the traditional NCSL, which is like on-ground DSA, DST business, which is done unsecured personal loan, business loan, and professional loan. There also the absolute value NCLs are coming down. So we are expecting the 6.4% of NCL of December quarter to further go down in quarter four, and that trajectory will be maintained in next year also. You will see that because they have cut down their almost 500 crore disbursement per month from this financial year. And now they are reaching to the same level of disbursement what they used to hit it last year. From the next year, they will get the benefit of base, and then disbursement look very high. So one side, the disbursements start picking up and NCLs are going to go down. And even in the case of NCL, I would like to tell you what we have done into the DSA, DST business, where we segregated the entire portfolio into 4 categories: and gold, silver, and bronze. And every quarter we have removed bronze, silver, and gold, and now we are only sourcing the diamond quality of the portfolio, which has got the very lower NCL as of now. But the NCL, overall NCL, because of the new portfolio, will start appearing after 1 year. So we are moving in that direction. By doing that, we have also successfully maintained our disbursement growth at the same level. And now we will start growing the disbursement with the better quality of sourcing. So the quality of sourcing is improving, disbursement growth is improving, and portfolio quality is improving in terms of NCL. So this is the good news from the CSL side.
Yeah, so the question was where should it settle ideally compared to 6.4 after doing this? If we are sourcing diamond category, 4 quarters down the line, what should be the steady state NCL in CSL?
That's what I said. That this entire book of diamond will be accumulated in next 2 to 3 years time, and ideally by that time we should go up. We should improve the number significantly. That is the number. So at this juncture, I don't want to commit any number,
Sure.
but 6.4 is very high, and it can come down definitely below 5% in next financial year.
Thanks. That's helpful.
Yeah, next is Piran Engineer from CLSA. Piran, can ask a question.
Yeah, thank you, and congrats on the quarter. Just firstly, in the M&HCV segment, we are seeing demand migration towards large fleet operators, and that's being then tapped by the banks. How is it in the case of LCVs and SCVs? And is that a risk you foresee for this segment also?
No, first of all, Piran, if you see in our HCV for last 2-3 years, we are away from HCV. And therefore, when the cost of funds started coming down, we started getting benefit too. We start acquiring more HCV customer. So some numbers are very, very, surprising to you that industry grew by 20%, but Chola grew by 56% in heavy commercial vehicle. But in the case of light commercial vehicle, we were already high. So therefore, our growth and market growth are more or less same. In the case of small commercial vehicle, the market is actually growing at the rate of, say, 16%. We grew by 28%, which is a high book. So in the commercial vehicle segment, in the new segment, overall disbursement growth is coming because of market share as well as the industry. So we are not seeing that the banks are always there in the the large and captive customer, we were always, into the SRTO. SRTO were away from the market because they were not seeing the capacity utilization. After the GST cut, when the cost of vehicle has come down and also EMI burden has come down because of the both interest rate cut and also total loan has come down because of the vehicle price coming down. The SRTOs are now getting into that. So our disbursement growth is not depending on whether bank is aggressive or not. It is depending on whether our segment is coming to the market to buy the vehicle or not. So we are seeing that now that is happening, and therefore HCV and small commercial vehicle started growing, and we are maintaining our market share at the similar level at the light commercial vehicle. Well,
No.
you want to comment?
Yeah, but no. So my
I
question
think
was
his question is different.
on the
Go ahead, Piran.
exactly. My question is different. It's more on like the market structure, right? Like, is the
Is it-
LCV market also heavily like towards fleet operators, or is it more fragmented towards SRTOs, which is why y'all can still continue to maintain
Piran,
that
yeah,
advantage? That's my
Yeah,
question.
definitely.
LCV is more into the SRTO and less into the fleet. HCV is
Yeah.
more into the fleet and
That's a question.
less into the SRTO.
Okay, and that will continue like this, you feel?
Yeah.
Yeah.
Continue. Because in light commercial vehicle, it starts from 3.5 ton GVW to say 19 ton GVW. So therefore, the range is large. As of now, the banks are concentrating in a high tonnage vehicle, which is like 10 ton plus. The lower tonnage vehicle is actually getting sold in the tier 3, tier 4, tier 5 town, where the people are buying for transporting vegetable at all. But they are mainly the market load operator, where the NBFC is only financing.
And
But
to add
yeah,
on that,
I mean,
the retail operators, be it in light commercial vehicle, that is IMLCV, Indian segment, and M&HCV, we are seeing a strong traction of retail operators, which is Chola's set of customers coming in from November, December, and that trend is continuing in the month of January.
so when you have like, the Amazons and all the e-commerce players which need that last mile distribution, do they end up outsourcing that to smaller transport operators? I would assume that, this segment also gets more and more formalized with the proliferation of e-commerce.
That is what
Yeah.
I said, no?
Okay.
In any case, that was there earlier, and they were actually being funded by bank. What I'm saying is that
No, his question is on the e-commerce shift, right? So the e-commerce shift, yes. So, Piran, to your question, the e-commerce players will prefer to contract with people that have a larger fleet. And you do see some people getting into fleets. But traditionally, so if you take the percentage that has gone to fleet in terms of these businesses, it is much, much less than heavy commercial vehicle. So heavy commercial has always been larger fleets. Here you see it getting a bit more formalized. But Piran, it's only that the e-commerce segment that basically demands that, right? Which is kind of this large level of formalization from their supply base.
Correct. Yeah.
Besides of
Okay.
that, there's not that many guys.
and also this is there for now for quite some time. So post COVID, we are seeing this like e-commerce buying the vehicle being funded by the banks are already there. It is not that this year it is getting changed. The electric vehicle is getting more funded by the banks because those are getting actually purchased by the large operator. So if the EVs are going to go up, then you will see the shift in that in terms of the mix between the banks and NBFCs.
Got it. My next question is on yields. Now, when I look at, say, SME yields over the last 9 months, they've been the same as it was in March 25, despite 100 bips of repo rate cut. Have we pruned low yielding business, or why hasn't the transmission happened? And likewise, even in LAP, and I'm just taking a longer time frame here. If I look versus pre-COVID and today, LAP yields are actually higher today, and it's counterintuitive given how much of SME, MSME competition we've seen in the last 5 years. So just your comments on how we've been able to sustain yields in both these segments would be useful.
On the app side, post-COVID, we have also introduced small app with a higher rate of interest, and
It's a business mix issue.
The business mix, which is kind of helping us in sustaining. We understood this is going to be a challenge, and we changed the strategy immediately after the COVID.
Okay, and in
Kiran, in
SME?
both situations, it's a business mix issue.
So
If you take a like-for-like product, you will see yields coming down. But one of the
Okay.
things we consciously are looking at is if we have to maintain, then kind of we do look at changing the mix as well.
yeah, lab
Understood.
has introduced a small lab, and that small lab is now started getting the momentum. So the amount of volume they are generating like 6,000, 8,000 crore. In that, around 20% is coming from small lab, which has got high yield, and therefore they are able to maintain the yield. At the same time, SME has given up the supply chain finance, and they have reduced their disbursement by 600 crore what they used to do it. And also they have introduced the
Increase of equipment finance, which is like our equipment finance business has gone up, which is a shorter term and a higher rate of interest, genset business. So that is helping us to improve our vertical.
Got it. Okay, this explains it. Yeah, thank you and wish you all the best.
Thank you.
Next in line is Shubhranshu Mishra from Phillip Capital.
Hi, good morning. Congratulations on a great set of numbers and thanks for the opportunity. The first question is around the growth itself. We're looking at a stellar growth which is coming because of the GST rate cut. However, are we in discussions with various OEMs? Is there any RM inflation which is to be passed, which could more likely offset the GST rate cut benefits that we have seen? Cafe norms is still in a discussion paper. Are we going to see any kind of rate and hikes by OEMs there? Second is if we can speak about various OEMs, what kind of market shares do we enjoy there, and what are we looking at in terms of market share increases? Say the larger OEMs like Maruti, Tata Motors, Mahindra, Ashok Leyland, the larger ones. The next question is a bit strategic in nature. What is our aspiration, or maybe when do we hit 1,000 crore PAT on an annual basis in each of the three new businesses that we've started, which is SBPL, SME, and CSEL? And the third is just a data keeping question. What would be our FEMI in the personal loans? Thanks.
Lot of questions, Shubhranshu.
So why don't you go on the OEMs and then FEMI you will give?
See, for the vehicle finance, as far as the OEMs are concerned, see, two things. What has happened from October, November, December across the segment, be it small commercial vehicle, light commercial vehicle, ILCV, M&HCV, passenger cars, all the market share we have grown. And as you know, we have our market share in Tata, Volvo Eicher, Leyland. These have all grown, and most of it are in double digits. Maruti, we have gained substantial market share across. Small commercial vehicle also we have grown. So, in fact, two-wheelers, we have grown our market share in Royal Enfield, in Honda, and of course in Hero also, because we are focusing in these three manufacturers mainly. So, to your question, that across the board, our market shares have gone up and the growth has been higher than the market growth. And the trend has continued in the month of January. We hope this will continue for this quarter and going forward.
FEMI, you have nothing?
Yeah. What is the question on FEMI?
Current FME rate.
FEMI, like I know it for the FEMI rate, it used to be peaked at 3.90%, but over the last 3 months, it has come down to 3.1, 3.2 types. So that is what. But no, I would like to tell you that FEMI is never an indicator for any of your metrics, because it requires what you call the registration, NACH registration with the bank. All those things are as a indicator. So I would say it has come down, but it is never a indicator from my past experience, I am saying.
Just one clarification on the market share. This is on volumes we are speaking of, right?
Yeah, market share
In
is
numbers.
only,
Okay.
the CM number.
Sure. The last part, 1,000 crore PAT
No,
in
so
each
in
of the
terms
three
of
businesses.
Yeah, I think the broad guidance has always been this, right? Which is like when we get into some of the newer businesses, the growth rates will be higher than the growth rates in some of our traditional businesses. But we obviously, we don't want to give guidance on when each of them are going to give 1,000 crores in PAT. So they just, I mean, I think that, so I don't think we'll give specific guidance on that.
Subhranshu, actually, if you see that the CSEL now is to the ROTA 1.4%, and what we have been discussing between me and Suchet that he will deliver 3.5% ROA, PPT ROA, which is normally we targeted from the next financial year. Both Vijay, Kini, Suchet put together driving the CSEL business. So most important thing is the ROA. In the case of SVPL, so if you take one by one new businesses, it's already delivering PBT ROA more than 7%, and SME started delivering more than 2%. So they are all moving towards the direction what we have set in the beginning in terms of profit.
Understood. This was very helpful and look forward to 1,000 crore PAT in each of these businesses. Best of luck.
Thank you.
The next question comes from Raghav Garg from Ambit Capital. Guys, just a request to all participants. We have a long queue, so maybe you can just keep your questions short and probably restrict to one question per participant. Over to you, Raghav.
Thanks, Nischint. Hi, and thanks for the opportunity. I have two questions. One, I just wanted to go back to the vehicle finance asset quality bit. See, when I look at your asset quality trends on this portfolio and compare it to peers, your trends seem to be a little inferior. Say, for example, the Q-on-Q drop in credit cost is lower, the YOY trend is higher. And even when I look at the net accretion to vehicle finance NPAs, it's on the higher side versus peers. So I just wanted to understand specifically with respect to your customer segment, in the sense that why is he finding it difficult to repay you versus, what we've seen for other auto NBFCs. Is there, some customer specific color to this or, any vehicle type color to this? That's my first question.
No, in our vehicle finance, if you know that our mix is not towards the one segment alone, it is actually distributed across all segments. That means we have been financing heavy commercial vehicle, light commercial, small commercial vehicle, new. Suppose you come up with any finance company which is more towards the used, the used is not so much deteriorated during last 2 years. The small commercial vehicle and light commercial vehicle plus tractor has deteriorated in last 2 years because of the 2 years back when the slightly monsoon deficit was there, and then capacity utilization got impacted during last two years during the first half. Having said that, what I mentioned in the beginning of the call today itself, that our vehicle finance stage 2 has come down from 3.96 to 3.61%. Whenever the stage 3 goes up, like it was 4.11 in September quarter, now it is 4.17, same level. First, stage 2 and early default and non-starters start coming down, and then subsequently you start seeing the results improvement coming in stage 3 as well. So the trajectory is looking very good in terms of vehicle finance. You are asking why it has gone up. I have said that it's because of the mix of both new and used, not that either new or used we are doing it. We are doing all product, and that is the reason things it started actually looking slightly high in the stage 3, but the trajectory is looking good from the early default and non-starter point of view, and you'll see the result in quarter 4 and going forward.
Understood.
And
Thanks
as
a
far
lot.
as the market and product is concerned, the product or market across the geography, we do not have any concentration in terms of any particular market or any particular product is basically doing very bad. It is all distributed across.
Understood. My second question is, I heard your commentary on early starter or non-starter, those metrics showing improvement. So my question is that, say for example, if we see 100 rupees of credit cost in the vehicle finance portfolio, how much of this would you attribute to this specific bucket of early starter or non-starter? And then if we see this number as percentage of say 2 or 4 quarter lag disbursements, would that be the right way to look at it?
No, majority of the NCL is coming from stage 2 and stage 3. Stage 2 is obviously much lower, as I mentioned. So stage 3 also we have not that we have one single provisioning. In the stage 3, as the high wind tires.
His question is, he's saying ED and non-starter contribute to what percentage of our
That ED non-starter is a part of the stage.
No, they are
low.
as a percentage of our NCL over time. So
Yeah.
from a cohort perspective, how much of it flows into
Correct.
this thing? So I think that's your question.
Yes,
Yeah,
that's what
go
I'm
ahead.
trying to
So
ask.
the behavior of the behavior of these two parameters indicates the business of the portfolio. So if it is coming down, then it means that the current portfolio is behaving better. So the impact of this will be seen over the next 4 or 5 quarters. Because that means if there is a lesser of early default and non-starters, then what happens is at a given point in time, the equity of the customer becomes larger, so he will not move out. That's the sort of the attribute we're looking towards as we move or keep reducing this.
See, my only point behind asking this question is because we don't get segment-wise stage 2 or even the net slippage on a segment-wise basis, just getting some color, as to how much of the credit cost in the vehicle finance is coming from the early bucket would just help in modeling the numbers better. That was the only objective behind asking this question.
So I think understood. So we can get back with that data. Right?
Sure. That'll be helpful. I have one more question. Can I ask?
Yeah.
So in vehicle, sorry, in the affordable HL, I think you mentioned 65 crores of principal has been sold to OARC. Is that right? Is that understanding right?
Yeah.
And despite
Yes.
that, the
Yes.
GNPA has come down only from 376 to 358, which means that there have been some slippages here too. Is that understanding also correct?
Yes.
Okay.
Yes.
So any specific or geographical
Yes.
color to this?
No, basically only the non-surfacey pool. There is a slightly increase in delinquencies, which we do all the legal means to collect out of that. So it is only the non-surfacey pool slightly gone up. It is not about any geographies. Geographies, in fact, everywhere the infant delinquencies are coming down, and Q4 we'll see this started coming down everywhere. So we'll maintain the NCL as 0.5 going forward.
Okay. Thanks a lot for all those answers. Thanks.
Thank you.
Next is Shreya Shrivani from Nomura.
Yeah, hi. I hope I'm audible. Um, uh, Thank you for the opportunity. I have two questions. My first question is on the vehicle book. So, in December and probably end of November, probably there were two cyclones that hit southern part of India. And can you help us understand what has been the impact of these cyclones on our customer base? Is there some stress that can show up in the 4Q numbers because of this pool? My second question is on the growth outlook for some of the for the non-vehicle book. We've backed out from the fintech portion, and we are going to scale up direct digital and consumer durable loans. Can you help us understand how much time will it take for you to set up the infrastructure for these two segments, and then the growth can kick in for you? So is the growth 4 quarters away or 3 quarters away in these segments, which are basically replacing your fintech book? Those are my two questions. Thank you.
Okay. So to answer the first question, as far as the South Zone is concerned, for the vehicle finance, last 4 months, South Zone had the collection across all metrics they have done well. For the month of Jan also, in spite of the highest holidays in a year in South Zone happens in the month of January with Pongal, Makara Sankranti, all this happening. So we have done extremely well in South Zone for the month till January. So we are not facing or we have not seen any kind of pressure or stress as far as the cyclone, and it has been very, very, very marginal. So there's not much of impact on the finance book in South Zone for Chola.
And as far as the CSL is concerned, there are two segments of CSL. One is the DSA, DST business, which we are now doing 700 per month, and then CD and digital lending book, which we are doing 300 crore per month, so close to 1,000 crore per month. Our peak was 1,200 crore per month, but quarter one of this financial year was only 2,000 crore. So if we do even 1,000 crore, we will do 3,000 crore. From the quarter one, you will see significant growth coming up. So, and as I mentioned in the call also, what are the corrective measures we have taken in order to improve the quality of CSL traditional, in terms of, removing the three segment of the portfolio, which were actually causing the concern in terms of the NCL, and still growing at the rate of 700 crore per month, which is going to grow the disbursement from quarter one at the rate of 25% plus.
Right. And in the digital and consumer durable, you said 300 crore. I am assuming that majority would be digital because consumer durable, the infrastructure, as in partnering with all these, all the stores, etc., would take time, right? So the 300 crore may be more digital. Is that understanding correct?
Digital is actually 100 crore, and
Mhm.
150 crore is around, Samsung. And then around 50 crore is the CD business, which we are doing through the Obama. So around 300 crore. And so 200 crore CD, 100 crore is digital. Still CD is higher than the thing.
Oh,
And
okay.
CD is only going to go.
Yeah, so we have the tie-up with Samsung Finance Plus. So already the infrastructure is all set as far as the platform is concerned. So we are distributing, or no, our distribution is based on the Samsung Finance Plus platform itself. We're able to acquire more customers across the country. So I think from a time lag perspective, that has been taken care of.
Okay, interesting. So, but you will be looking for more tie-ups in the CD, right? I mean, this must be
Yes,
your
yes.
first. Yeah, all right. Okay,
How
okay.
many tabs we have now? We already have about 9 types. We've already covered about 75% of the entire mobile market. So we are actually working on distribution on the open market platform for CD. In addition to,
And then Shreya, we just moved out of mobile into household appliance segments as well. So this is it's going to kind of grow in different tiers over time, right? So the first part is going to be mobile, and then the second part is going to be non-mobile, other household appliances as well.
Got it, got it. This is very useful. Thank you and all the best.
Thank you.
Thank you.
Next comes in Viral Shah from IFL. Viral, you can ask the question.
Hello. Yeah, am I audible?
Go ahead.
Yes, sir.
Yeah, good morning. Thank you for the opportunity. So I had two questions primarily. One is I was looking at your comments with regards to within the vehicle finance industry, and therein you have mentioned that the used vehicle finance prices saw good demand with replacement cycle kicking in or expected to kick in and prices declining. So over here, just wanted to understand first of all two parts to it. Which sub-segment of this, I would say within vehicle, the used segment is seeing a demand pickup because of replacement? And secondly, what is the extent of the used CV prices declining? And if at all you see any concerns with regard to asset quality over there? I'll ask the second question after this.
See, there are two things. And see, immediately after the GST GST reduction was announced, there was a lull for almost 15 days. Subsequent to that, the market got corrected. And the initial spurt in demand happened in the M and HCV segment at the retail operator level. The real movement in, and subsequently it has flown towards the ILCV segment. So M and HCV to ILCV segment. And in the M and HCV segment also, in the used business, the initial was on the haulage segment. And from January, we are seeing a traction coming up in the tipper segment also, because a lot of contracts have been released and the usage for the secondary segment, there is a demand for tipper also coming in. So this is where it stands. See, at the small commercial vehicle segment and all, we are yet to see a huge, but it's more or less BAU as far as the small commercial vehicle segment is concerned in used business. ILCV, we are seeing a traction coming up. M&HCV started. From haulage, it has moved to tipper. So this is what the current scenario is.
Just to continue, Viral, this is also linked with the new HCV and new LCV sale. As the HCV market is growing, the replacement cycle also kicking up for the use. The people who are buying the vehicle, they are not only adding the vehicle, but they are also sometimes, replacing the vehicle what they have. So when they sell their existing fleet and buy the new vehicle sales picks up and old vehicle sales also picking up. So both are going to get benefited, because when the existing customer having the vehicle are selling, and that vehicle comes in the market, quality of the vehicles are good, and that vehicle gives better price than the vehicle which comes through the repo, repo sale and all. So now the quality of the used vehicle coming in the market after say December or say after November, quality wise better. Little bit drop is there in terms of valuation of the vehicle, which is hardly 5%. But it doesn't matter, because at the end of the day, if someone wants to buy new vehicle, wants to sell the vehicle, he need it for his replacement. Customer need it for their deployment. So that is not important. Important is that the vehicle is available for us to finance, and therefore our used business is going up from December onward, which is likely to go up further in Q4.
Right. And how long, sir, do you see this replacement cycle playing out? Is this something that you expect over the next few quarters, or is it just 4Q?
Yeah, so it is simple. The last 2 years, there has been lull in the new vehicle sale. So new vehicle sale now only it started picking up. Commercial vehicle did not pick up immediately after the GST cut. It started only in December. In fact, December was very low. January, I'm seeing the peak impact is coming, and the passenger vehicle, whatever we have seen in the Q3, that is it remains same. It's not going up. So now the disbursements are driven by the new vehicle sale of commercial vehicle side, which is going to also support the used vehicle side. Suppose new vehicle is continuously, I'm talking about the heavy commercial vehicle and light commercial vehicle, is continue to grow at the rate of say 15% or even 10 to 15%. Obviously, to that extent, the used vehicle is also going to come in terms of unit. Now, when you are financing it, the GV value is actually matter for financing. So if that is the case, 10 to 15% is the unit number, it converts into the value, it comes to 20% plus. And it can continue for till such time new vehicle sales continue.
Got it. And secondly, sir, the question was more for Arul, sir. Sir, how do you see now the cost of fund trajectory for you, given how the bond yield movements have been, especially not just today, but I would say over the last 3-6 months as well. We have barely seen any reduction in the GSEC rates. So how should we think about it, and consequently the margins also going ahead?
You're right. There has been tightness in the liquidity as well as on the rate. So, but I think the good part is we have a mix which is also partly fixed rate borrowings. So there is steam left in that to reduce more on the NCD side, on the market borrowings, and the MCLR side on the bank borrowings. These two will still give us another 5 to 10 basis points on the cost of fund reduction in next quarter is working on, which should at least to a large extent flow through to the NIM.
And so beyond that?
Beyond that, I don't think there is.
I know. I think only.
Beyond that, we need to increase the NIM through business only. So in the Q4, obviously, due to better collection, your other income goes up, and you have seen that last year, if you take the investor presentation, you are able to see Q4 NIMs are always higher. So we are going to expect that also in this quarter.
Got it, sir. Thank you very much. I'll come back in the queue. I have just one more question, if it is there.
Please.
Next question comes in from the line of Akshay Jain from Autonomous.
Hi, sir. Thank you for the opportunity. So my first question is again on margins. So while you have indicated that next quarter the margins will go up because of two impacts. One, cost of funds will come down, and number two, other income being pretty well in 4Q. So currently the NIMs are around 8% odd, and maybe next quarter, given your guidance or given your outlook, it can go up to say 8.1, 8.2 range. But how should we look at F27? Like, should we expect this margins to be held around similar levels, 8.1-ish, 8.2-ish levels? Or how should we think about NIMs incrementally? And what will be your incremental cost of funds in this quarter?
First of all, I said 5 to 10 basis points. You took it to 20 basis points.
No. So I included the other income as well.
So
No, all put together only income. So the 8.1 could be the quarter 4 number. So overall, we should end the year with around, shade less than the 7.9 we are talking here. I expect it to hold next year to a large extent, unless there is some drastic increase. I don't see any reduction coming through beyond current levels. But I hope, unless there are some no macro issues cropping up, that should not be increased also. So we should hold at the current.
Understood. And on the AUM growth, while you have guided for a wide range of 20-25%, and given the strong Q3 and your comments on continued strong January, so should we expect the AUM to grow, at the higher end of this range?
No, see, it is the same thing in the reverse way. When we dropped, disbursement dropped in Q1, Q2, AUM didn't drop that far. So same way, when in 1 or 2 quarters of disbursement, peaking, AUM will also not react so fast. So still we hold the 20-22% AUM growth for the current year. Yes, we will look at opportunities to improve, but I don't want to give any guidance beyond that.
Understood. And any guidance on the credit cost front also? Because for this year, you had mentioned around 1.6%, and 4Q is expected to be strong for Chola. So
It's the third question. So should I skip it?
It's fine, sir. Like, if you can answer it, it will be great. Hello, am I audible?
Yeah. Akshay, you have any other questions?
No, it's fine. Okay, thank you.
Thanks. Next question comes from the line of Arvind Ravichandran from Sundaram.
Hi, can you hear me?
Yeah.
So my question is, most of my questions were answered, but one question is on SBPL business. We are seeing continuous increase in NCL and SBPL business. I understand it's on the low base, so the growth is still coming through. But do we see any risk to that the growth in that particular business? And similarly, in lab business, should we expect margins to, spreads to hold largely, considering a mix is shifting towards small ticket lab? These are my two questions.
Yeah, I request the management to answer. There's no response from the line. Probably just hold on a minute.
Oh, sure.
The management should just be connecting with us any moment.
Hello, Nishan.
It is dial in on.
Yeah, I'll put
do it
you
from
on
here.
speaker. You connect here. Can you connect on this?
Yeah, you are on the, sir, you are actually on the Zoom call. You can answer your questions.
Yeah,
there?
connected.
All right.
You'll be connected, yeah.
Okay. Can you hear us now?
Yeah, you can. So you can. So probably Arvind, you can ask a question once again. Sorry.
Yeah,
Please go
sure.
ahead, Arvind.
Yeah. Thank you. Thank you for the opportunity. So my question is on SBPL business, where net credit cost is moving up continuously for the past few quarters. So do we see any risks to growth there, in the near term, into that business? And are we comfortable with this level of credit cost? That is my first question. And second question is on lab business, should we consider then spreads and margins to hold largely despite rate cuts which has come through because of the mix change which is happening continuously? And if I can ask one more question, in affordable housing segment, should we start to see again disbursements growth picking up?
Yeah, for SBPL, the credit cost for Q3 may look higher, but it has basically reached a peak. We don't see any more damage as far as credit cost is concerned. In fact, actually, if you go geographically, two of our zones have already started improving in December and January. It will reflect in Q4 end or Q1. Definitely, you'll see stabilization of that, and further to that, it will start moving down.
And also, we mentioned that in the past that SBPL is entirely a non-surfacey book. So the collection is through a traditional way of doing legal and also the follow-up on ground. So traditional way of doing legal means it takes 2 to 3 years time. It requires a cycle of resolution of the cases which is there in the pipeline. So now we started getting resolution through legal in some market, and some market we yet to get it. So that's the reason Ashish is commenting that the NCLs are picking up now here, and from here we can actually expect that the NCL will go down. And also in the case of SBPL, we will time to time we will see that how we can actually do some ARC sale and reduce the stage 3. That is also in the pipeline. Their PBT RO is quite good at a very high level at 7.3%, and they will continue to deliver this. In the case of HL,
in case of LAP, if you cut it last year to current year, there's a 20 basis points increase in the margin. But this is primarily, as I mentioned earlier, also it's primarily because of the product mix. We are continuing to expand our higher interest product. But equally also we are expanding our geo to the tier 3, tier 4, which is also helping us in sustaining our yields. Now, this yield, the NIM would be about at the same range. We will continue to hold it at the same levels, and that could be a slight increase in the. If you look at the Q3 OPEX is about 1.8%, and the YTD OPEX is 1.7. It will again be at the same range bound, 1.7 to 1.8. I think there should not be any material impact on the overall ROA. If at all, that could be a 10 basis points maximum. Otherwise, it will be at the same range.
And for HL growth side, we have seen a good quarter, and we hope to see. We have always maintained that the book growth, the AUM growth will be around 28 to 30%, and we see that coming for next 2 years.
Sure, sir. Thank you so much. Thank you so much.
Next, we have Nilesh Jain from Investec.
Thanks for the opportunity. So my question is on growth and asset quality. So if I look at segmental data in home loans, our GNPA has been increasing. If I add the ARC transaction in SBPL, also our GNPA has been increasing. There is slight increase in SME also. So what gives us confidence in growing these segments? In the CSEL segment, when the GNPAs were increasing, we have slowed down the growth. But in these segments, we are continuing to push growth. So what is giving us confidence to continue to grow despite increasing GNPA?
So we have seen that in the case of HL, LAP, and SBPL, even in the SME, there are two type of customers who are getting into the stage 3. One we can be resolved by the surfacey, and one is the non-surfacey. Surfacey cases are getting resolved because in this property business, mortgage business, when you have a property, you will get the money because it's a appreciating asset. So there is no point that you're going to lose money unless you have a problem in the property itself. So we are confident that the underlying security is in place. It's just a matter of time, either surfacey 9 months to 12 months, or non-surfacey it takes 2 to 3 years. So that's the reason we have done the deal in the case of non-surfacey in the HL book, and we are seeing that even after doing all these things in the HL, the steady state NCL going to be 0.5 to 0.6%, and their ROA going to be PBT ROA going to be 4.5%. Similarly, in the case of LAP, they are committing that they will be continue to deliver 3.7 to 3.8%. And in the case of SBPL, again, they are delivering 7% plus PBTR. In the case of SME, as we mentioned that since the term loan book, which is actually again with the mortgage of the property of the customer, which takes time because here the entire book is SARFAESI, but it is a corporate customer where the SARFAESI takes little bit more time because of the customer contest little, for a longer period. And that's the reason SARFAESI cycle in the SME, it takes 1.5 years. And we are seeing that some results have started coming in the month of December, which is going to continue in Q4, and Q4 onwards, you will see with a better result in the SME in terms of the stage 3 reduction and NCL reduction.
Sure, sir. Okay, thank you. That's it from my side.
Yeah, thanks. Next question comes from Sonal Gandhi of AMSEC.
Yeah, thanks for the opportunity. So my question was more on the PBT ROTA. So for a long time, we've been guiding, that we'll be closer to 3.5%. Obviously, we understand there is issue with credit cost, but, going ahead, maybe when we are also, talking about consumer durable business. Okay, so that's a high, infra heavy business. Probably ROAs would not come until you reach a scale. So how do you see OPEX and how do you see PBT ROTA for CSEL and overall business say for FY27 and FY28? And second one was on the impact of new labor code. So are we done with the entire, have we taken the entire impact in this quarter? Is there anything remaining for the Q4?
Labor laws.
Yeah, the CSEL business still is a very small percentage of the overall AO, so around 7% of the overall AO. And as we scale up, we will certainly make sure that it starts contributing at the same or a similar expectation levels of about 3% ROTA and progressively build thereon from there. So that should not be a change. The larger impact would be once we correct the vehicle finance business and then the other businesses coming in with their expected levels of ROTA. Those two will be the contributing factors to reach the 3.5% pre-tax ROTA. And with regard to the labor code, yes, we have provided for the gratuity fully for all the past period based on the actuarial valuation. And that's been completely covered. The rest will be only on a month-on-month basis changing. So there may be a slight difference in the salary cost as we do some corrections with regard to the wage definition per se, but I don't see that as a big game changer.
Sure. Thank you, sir.
Thank you. We'll now just take the last question from the line of Abhijit from Motilal Oswal.
Yeah, thanks, Nischint. Ravi sir, just two questions. One is, if you look at this financial year's FY25-26, right? I would say, difficult years from March 24 to now. We've discussed in the past, right, that infrastructure spending has actually been very slow. I think I heard in the call earlier today that GST cuts, and we are seeing very good momentum in Q3, expecting that to continue into Q4. But if you look at the asset quality, right, from March 24 to now, right, just one direction, things have kept deteriorating. Do you think this is just to do, with the weak macro that we are seeing and for a significant improvement? Because obviously we are in Q4, we could look at a better Q4, but then we again head into the seasonally weaker first half of the next fiscal year. So, what do you think we really need, right, as an industry at Chola, right, for things to substantially start improving from here in terms of asset quality? And the other thing is, in terms of non-interest income, are there any initiatives that we are taking to improve the fee income or the non-interest side of things, non-interest income side of things? Those two questions. Thank you so much.
So good morning, Abhijit. See, for last 1.5 years, starting from, as you mentioned, 2024, immediately after the election, or from the election year itself, that quarter itself, we started seeing that there is a problem in terms of vehicle finance, in terms of the NCLs are going up. And then it is coupled with, so in our business, we have 8 business lines. Out of 8 business lines, we have only 2 business lines where the NCLs are high. One is vehicle finance, the CSEL. So vehicle finance is entirely due to the macro. And CSEL is because of the partnership business has gone slightly higher. That is one reason. So it is not related to macro, I'll say. It is because of the segment. And also in the case of CSL traditional, which is unsecured, we want the professional, personal, and the business loan. It is because of the type of process it is being adopted by entire industry, that at that point in time the multiple fundings were happening, customer number of loans being given by given to one customer were high, number of inquiries were high, and that is the reason in that segment the NCL went up, which is because the number of players suddenly went up, and then the DSA, I think I can say the little advantage they have taken, and therefore that segment got impacted. Otherwise, when that segment was done by few players, that problem was not there. So if you see CSL and we have business where 600 crore and 300 crore put together, 900 crore NCL is coming quarter. I am expecting that number will start significantly going down because the capacity utilization in vehicle has improved significantly. And as you mentioned that stage 2 is coming down, that means collection efficiency is improved. That is going to start showing up in the NCL also from the quarter 4. Now coming to the future, the seasonality effect is going to be there. There has been two problems in vehicle: seasonality and cyclicity. So I am expecting that the cyclicity problem is going to get resolved if the vehicle demand is continued to be there from now onwards till next 3-4 years, as we have seen that the cycles are actually 4 years up and 4 years to 1.5 years down. So that's vehicle finance. The good news if the cyclicity gets resolved, since seasonality impact is going to be there, and that is the effort we need to put it on ground, which I think because during the cyclicity we improve the collection feet on the street on ground more. Then after the cyclicity problem get resolved, our collection efficiency improves significantly. So vehicle finance is going to be better, significantly better from quarter 1. If the cyclicity problem is not there, seasonality is there. Now coming to the CSL, as I mentioned, the indication is that our numbers are looking better because the partnership book has already come down from 3,000 crore to 600 crore. So the partnership book NCL is completely getting eliminated from next financial year. And traditional CSL business, their ROA, their NCL is also started coming down. So both put together, their NCL will look better. As we mentioned that they can go down as low as 5%. So both the side we are benefited in time to come.
Got it. And thank you, sir. And the last thing on the non-interest income side, are we taking any initiatives there to improve the
Non-interest as such in our business is not much. The fee income, what we do it by doing the, protecting the asset and the life of the customer, what we do, good income is coming, and then other income is coming from the additional finance charges and all which we collected. So what is going to happen in the time when the collection improves? I mean, this is very specific to vehicle finance. Whenever collection improves, their other income goes up. And that is the reason the fee income or other income, whatever you say, that is going to go up in the quarter 4. And if that continued, as I mentioned, if the cyclicity is improved in quarter 1 onward, and their collection is improving, stage 3 is coming down. During that period, for short period, for at least 1 year, you will see that their overall income will be high.
Got it, sir. This is all from my side. Thank you so much, and I wish you and your team the very best.
Thank you. Thank you so much, Abhishek.
Thank you very much. This concludes the call. Thank you, participants, for joining us today, and thanks a lot to the management for giving us an opportunity to host the call.
Thank you. Thank you, Nishant.